Good evening and welcome to our taxation class for ATS3. Now we are discussing taxation of investment income. My name is Chima. Now, last class we discussed taxation of business income, so taxation of personal income, and we talked about the payee, how to calculate payee. We spoke before about the difference between contract of employment and contract for employment, and that one of them is employer-employee relationship, while the other one is vendor relationship. We now did some solving of employment income, how we can get the chargeable income and the tax. Believing that you've done some of the assignments which were given to you, we now want to go to another topic, which is taxation of investment income. So, we are going to know what is investment income. We are going to see how to compute rental income chargeable to tax on properties. We'll look at the implication of dividends and interest. We'll look at royalty income, basis period, and payment of tax on investment incomes. Then we'll look at frank investment income. So let's go straight right away. Investment incomes are incomes received primarily from investment decisions. Now, this is opposed to business income or employment income. In employment income, these are income you receive from being employed by someone. Business income is income you received from either trading or doing some other business. But in investment income, you don't trade, you don't get paid as an employee, but you get income from investment decisions. What are some of the investment decisions that someone can take? You can purchase shares. For example, GT Bank is currently selling their shares, and when you buy these shares, you become a shareholder. And so, when this GT Bank pay dividends, that becomes an income for you. You can purchase property. Now, not just you purchase property, this property be for letting purposes, meaning that you purchase a property and you want to generate income with it. So when you are a landlord of a building, and now this building, people pay you rent. If people pay you rent, that means it is for letting purpose because it's for let. So you receive income, and this income is investment income. Or you could give people, you can put cash in a fixed deposit. When you go to a fixed deposit and you go to your account and you put a fixed deposit in the bank and they pay you a particular interest, they call it interest yielding account. Fixed deposit is there as an example. That interest is investment income. Or you give out loan to a company and the company pay you back the interest with the principal. So this is investment income. So the incomes that accrue as a result of investment decisions are investment income. And there are four in number we will talk about: dividends, interest, rent, and royalty. We'll talk about this. Now, let's look at rental income. Rental income. The gain or profits arising from other person's use of your property is a rental income. And this rental income is chargeable to tax. So it means that you have a property, you rent it out, you put it out for let, someone rents it, the gain you get is rental income. Rental income is generally deemed to accrue to the recipient daily. So day to day, so it's accruing daily. Now, most times when you pay your rent in advance, isn't it? Because you want to pay, the landlord will say you will pay for 1 year or you pay for 2 years. It is payment in advance. Now, assuming you are the landlord and your tenant pays you rent in advance. If rent is received in advance, it is still an income. It will be spread over the period of the rent. So it means that if you receive rent for 2 years, what you will recognize for the current year will be 1 year. So if somebody he pays you 2 years, 2.5 years, 3 years, you will recognize the rent for each year. You will not recognize the whole money you receive for 1 year as your income. No, it will be spread. That is in accordance with the accrual concept. Now, they said there is a limit, provided the the period is not more than 5 years. So it means that you shouldn't receive in advance for rent more than 5 years. Now, if it is received for more than 5 years, the law says that it will be spread for 5 years. So if you receive it for 6 years, you will be spreading it for 5 years. So for tax purposes, the gain or profit arising from the rent of a property is ascertained by deducting only those expenses that were directly incurred for the purpose of earning income. So what it means is that if you want to charge income, rental income to tax, you see the rent that the tenant pays you, that is credited to your account, right? It's an income, rental income. Now, there are certain things you would have done to ensure that you make that income come to you. You will deduct those expenses. And what are those expenses? They are called allowable rental expenses. For example, we have tenement rate or land use charge. Now, if the landlord pays a land use charge for the house that he's putting out for let, it means that the landlord will deduct the land use charge as allowable rental expenses. Now, cost of collecting the rent. For example, you have a caretaker and you ask your caretaker to collect this rent for you and you are giving him a percentage, or you use an estate manager or estate agent, or you have your lawyer collecting this rent for you and you are paying him your lawyer's fee. This is the cost of collecting rent, because sometimes some people might be so familiar with the landlord that they will decide to owe him, or sometimes some people will not pay as and when due until a legal representative is involved. And so this is a cost of collecting rent. What about cost of advertising for tenants? You put up your adverts on the media, the mass media, the TV, the radio, even in the newspaper or social media, you run an advert and you are advertising for your house, you are expending rental expenses. So these are expenses that you should incur normally for earning this income. Then any expenses incurred for repairs and maintenance of the building. So it means that no tenant will want to come and rent a place that is in disrepair or that is in dilapidated. You need to put it in good order, give it a facelift, repair, maintain the building. It means cost of painting, cost of small repairs. All of these things is just to put the house in good order so that it can be rented. Now, bad debt incurred. Now, some people will live in a compound or in a house and will not pay their rent. Maybe they are owing 2 years, 3 years, or they go to court because you give them a quick notice. That period that you gave them that they will stay, they are not paying you rent. You are not earning income. The income during that period is a bad debt because instead of them paying you in advance, they are living for free. You have incurred a bad debt because the tenant is like owing you and is not paying. Sometimes you may borrow money, let's say from the bank, or you borrow money and you are paying interest. Interest on money borrowed. As long as you use that money in either acquiring the property or renovating the property, you borrow that money. When you are paying back the loan, the interest part of that interest part is allowable. Now, we have commission paid to a caretaker. Commission paid to caretaker. This is something like cost of collecting rent. Commission paid to an agent or caretaker. Then we have insurance premium paid on the property. You pay insurance premium on the property, insure your building against fire, against burglary. These are insurance premium, they are allowable expenses. Then water rate. Now, sometimes now, water rate is not paid by the landlord, right? These days, just as tenement rate is also not paid by the landlord, but land use charge is paid by the landlord. So whereas these ones were not borne by the landlord cannot take them as allowable expense as long as it is not borne by him. But if it is borne by the landlord, then it is allowable. So we've seen about 10 or so allowable expenses that you can deduct from your rental income. What about disallowable expenses? Disallowable expenses will include any expenses not incurred for the purpose of earning rental income. So it means that if you make any expenses that is not for the purpose of any rental income, that is not allowable. Now look at an example. You have a property, maybe a bungalow or let's say a duplex, and the landlord is staying in one wing and he gave out the other wing for let. Now, if he does a repair on the general building, the part that belong to the landlord cannot be said that he is earning income from that side. He needs to deduct the part that he himself enjoy because he is not earning income from himself. So let's say you paint the whole building. The paint that you spent on the landlord's part needs to be deducted because landlord will not be collecting income from himself. If you make repairs, only the repairs to the tenant side will be recognized. Then the next one is expenditure of a capital nature. Now, this is different from repairs. Repairs is not a capital nature. Maybe repairs may be some places is falling, you put finishing touches. Painting is also like seen as repairs. Maybe you patch some holes, you fix the plumbing system, you fix the kitchen. This is not a capital nature. So what do we mean by capital nature? One, you did a gutter. Gutter is a capital nature expenditure. You did a projection. So let's say you wanted to do a shade, a sunshade, and you now build a sunshade. From the building, you now put an extension to it. Instead of going to buy canopy, you now decide to build a shade. It's a capital nature. Even the canopy you go to buy is a capital nature expenditure. Then we have depreciation of the building. Depreciation of the building is not allowable. Always depreciation is disallowed. Then appropriation of profit. Appropriation of profit. So this is what the part that the landlord enjoys. When the landlord collects part of the profit, it is not allowed. Part of it includes paying income tax. So appropriation of profit, anything you spend out of profit, anything you spend out of profit is not allowed. So it means that the whole profit should be taxed. So, but if you spend things out of profit, like income tax, it could be any kind of tax. Then drawings. Drawings is when the owner, let's say the landlord, takes money for his personal use. Maybe landlord receives money from rent. He now take maybe 20% of that money and use it to do his personal runs and not for the benefit of the business. That is drawings. Let's say, for example, he used the money to pay his son's school fees. That is a personal thing. Or there is no food in the house. He now takes money from there to go and ask them to do food. That's drawings. So anything that is spent should be for the business. If it is not for the business, it is not business related. It's from profit, it's drawings. Then we have reserves. Reserves are part of that your profit that you keep for expansion. So it means that let's say you have a profit of 1 million naira and you say, I'm going to keep 40% somewhere. I won't touch it. I have reserved it. That's why it is called reserve. I have reserved it. Now, that money you keep as reserve, it is not an allowable expense. You are keeping it because you are trying to look at expansion. You now tell yourself, okay, 60%, let me use 60%. It is from there that the tax will be paid. It is from there I will use to do my drawings. It is from there I will do personal things. I want to spend 60%. while 40% is kept for expansion. So that's it. So we've looked at rental income. This is income that the landlord receives. And so the landlord will make some expenses in order to get that income. And those expenses he makes is classified into two types: allowable expenses and not disallowable expenses. So the allowable expenses are deducted from the income in order to get your net income. It is the net income that is subjected to tax. So we've done rental income to dividend income. So dividend income is another income that is investment income. Now, dividend income is the profits distributed by a company to its shareholders in proportion of their respective shareholding. So it means that in the ongoing GT Bank shares that they are selling, if you buy the shares, you are a shareholder. Let's say you bought 1% of the shares. For somebody to get 1% of GT Bank shares, that means you have money. Let's say you have 1% of the shares, right? That means you're a 1% shareholder. Your proportion is 1%. Now, let's assume again that after 2 or 3 years, GT Bank made 10 million naira as profit. It's an example. Or 100 million naira profit. Let's use that. 100 million naira profit. And okay, let's say that is a part of the profit they want to share to the shareholders. They want to share 100 million naira profit as part of the overall profit they want to make. Because normally when a company makes a profit, it will not share everything. It will keep some part as reserve, and some part it will distribute to the shareholders. That part that is being distributed to the shareholders is called dividend. I was given an example. Let's say the part they want to distribute to shareholders is 100 million, and you have 1% share. The money they will give you is 1% of 100 million, which is 1 million. All right, so that's it. Then we have Nigerian dividend. What is Nigerian dividend? This is the income from a dividend distributed by a Nigerian company. So when a Nigerian company distributes a dividend, it means it is Nigerian dividend. Now, when a Nigerian company distributes dividends, it shall be the gross amount of that dividend before the deduction of any tax which the company is required to deduct. So what they mean here is that the income from a dividend distributed by a Nigerian company shall be deemed to be derived from Nigeria and shall be the gross of that dividend before the deduction of any tax for which the company is required to deduct. So what it means here is that, let me give an example of a Nigerian company. Let's say Glow. Glow is a Nigerian company, right? Why do we say it's a Nigerian company? It is incorporated in Nigeria, as opposed to MTN, which is not a Nigerian company and it is not incorporated in Nigeria. So let's use that. Glow PLC is giving out dividends. If Glow makes profits, let's say Glow is not only in Nigeria, Glow is maybe in several countries. All the monies it makes from all the several countries are all Nigerian income. Now, when Glow is giving out its dividends, that is Nigerian dividends. And dividends is recorded at gross. Dividend is recorded at gross. I would say record at gross. What do we mean? What we mean is this. If a Nigerian company is paying you dividends, which is gross, they are supposed to give you gross, but they will not give you gross. They will remove tax called withholding tax, and they will give you net. So even though they give you net, this place is saying that it shall be the gross amount of that dividend before the deduction of any tax. This withholding tax is the tax they are talking about. So when you are recognizing your dividend as a dividend income holder, you will recognize it as gross, even though they have deducted net. They have deducted withholding tax. Let's give example. Now you are supposed to receive 1 million naira, right? From 100 million, you have a 1% share, and the dividend they are giving out is 100 million. And because you have a 1% share, they are giving you 1 million naira. Now, the company will not give you 1 million. The company will remove withholding tax, which is 10% of 1 million. That means 100,000 will go out of the money, and you are going to get 900,000. Now you have a bank alert, you see 900,000, and they label it dividend income. How do you record it in your book? You don't go to your book and say, oh, I received 900,000, I will record 900. No, this place is saying by law, that 900,000 you received is net. They have removed withholding tax. Go back and add the withholding tax. Though you didn't receive it, go back and add it and put it in your book as gross. So it means you have to record it at 1 million, even though you receive 900. We have undistributed profits of a Nigerian company deemed to be dividend. Now, they said any amount of the undistributed profits of a Nigerian company which is treated as under the provision of any law in Nigeria imposing tax on benefits of the company shall be deemed to be derived from a dividend to any person or share who is a shareholder in the company in proportion to his share. So what they are telling you here is this. Okay, you decide that you have 10 million naira as your okay, let's say you have 100 million naira as profit, right? And you told yourself that there is a policy of reserving, let's say 30% or 40%. Let's say you reserve 40%. That means out of 100 million, you reserve 40 million in your reserves. You are supposed to distribute 60 million, right? But maybe because of being cautious or so, You decided not to distribute the whole 60 million and you decided to distribute 20 million. 20 million is distributed profit. The remaining 40 million is undistributed profit. You will still be taxed on that undistributed profit. It is deemed as though you have distributed it. Now, dividends exempt from tax. The following dividends are exempt from tax. Dividends earned from abroad and brought into Nigeria by Nigerian residents in a convertible currency and paid into domiciliary accounts in a bank approved by the government. So what it means here is you are a Nigerian resident. How? We learnt about the resident rule that for you to be a Nigerian resident, you must be living in Nigeria. Or if you are going and coming in Nigeria, you must have been in Nigeria for about 183 days. Or you are a Nigerian diplomat in a foreign land. These are the three things that makes you a Nigerian resident. Now let's say you are living in Nigeria, but you bought shares from abroad. How can you buy a share from abroad? You buy a share in a company that is not incorporated in Nigeria. Either the company has business doing in Nigeria, or even though the business is not even in Nigeria's shores, it is outside, but you bought somehow, and they are paying you dividends, and you are receiving it in your domiciliary account. As long as that dividend is in your domiciliary account, that is not taxable. So it means that if they are paying you money dividends in your dollar account, and you have a dollar account, let's say in GT Bank, you have a dollar account and they are paying you dividend income there, that dividend is not chargeable to tax in Nigeria. So it means that the withholding tax is not going to be taxed in Nigeria. Now, dividend paid to a person by a company incorporated in Nigeria, if the equity participation of the person in the company paying the dividend is either wholly paid for in a foreign currency or by assets brought into Nigeria between January 1, 1987 and 31st December 1992. So this is a special case where dividends are the equity participation between these two dates are looked at. But the main thing here is the most one that you will see mostly in exam is if it is earned from abroad. If it is earned from abroad and brought into Nigeria and put in a domiciliary account. All right. Relevant territory in which dividends paid by a Nigerian company arise. Where a dividend is distributed or paid by a Nigerian company, the dividend, whenever necessary, shall be deemed to be derived from the territory in which the recipient of the dividend resides, or where the recipient is not resident in Nigeria, the person shall be deemed to be resident outside Nigeria and who derives income or profit in Nigeria. So any person who is not a resident person in Nigeria but is derived dividends from Nigeria is seen to be resident in the Federal Capital Territory. Now, what it means here is that if you are not a resident individual, we've talked about resident individual before, that your dividend is brought from abroad is not taxable. But now, let's say you are not in Nigeria, but you are earning a dividend from Nigeria. Nigeria will tax you, just as when you are bringing your dividend from abroad to Nigeria. The people abroad would have taxed you, but Nigeria is not going to tax you. So the same thing here, when you are earning it from Nigeria and you are a non-resident person, means you are taking your dividends outside Nigeria. Nigeria will tax you. Nigeria will look at you as living in the Federal Capital Territory. Now let's go to interest income, because we have looked at dividends income.
Are you there, sir?
Now, can you hear me? Yes, I believe you can hear me now. All right, don't need to reply. I believe you can hear me. You can reply on chat if you can hear me. All right, so we come to interest income. Interest income is the next thing we are talking about now. We said interest is the reward you get for lending your money to an individual or a company. So income from any interest or money lent by an individual or executor or trustee outside Nigeria to a person in Nigeria, including the person who is resident or present in Nigeria at the time of loan, shall be deemed to be derived from Nigeria if there is a liability to payment in Nigeria of the interest, regardless of what form the payment takes, whenever the payment takes, the interest accrues in Nigeria to a foreign company or person, regardless of what form the payment takes and all that. So what we're saying here is any money you lend to anybody that bears interest, that interest is interest income. Now let's say, for example, you lent 1 million naira, okay, and you say the 1 million naira has an interest of 10%. That means the 1 million naira will yield 10% interest, which is 100,000. If the person pays you 1,100,000, the 1 million is the capital, the 100,000 is the interest. It is that 100,000 that is the interest that is called interest income. Now, interest can be received from sources outside Nigeria. So where an individual is resident in Nigeria, the interest accruing to him from a source outside Nigeria is liable to tax in Nigeria if you bring it to Nigeria. But there's a clause. There's something called double taxation provisions, which is outside the scope of this. So there is something called double taxation. So it means that you are in Nigeria here, you earn foreign interest. Maybe you gave out a loan to a foreign company and they are paying you in Nigeria, even in your domiciliary account. Now, that interest is chargeable to tax. Now, unlike dividends, that if you are earning it from outside and bringing it to Nigeria, it is exempt from tax. In interest, it is chargeable to tax. Now, let's look at interest exempted from tax. Interest accruing to a person on a foreign domiciliary account. Foreign domiciliary account. So it means that this is different from dividend brought into Nigeria and paid into a Nigeria domiciliary account. But here, if the interest is in a foreign domiciliary account, it means it has not been brought to Nigeria. It is in a foreign account. It is exempted from tax. With effect from January 1, 1996, 100% of certain foreign incomes are exempted from tax as long as these incomes are repatriated into Nigeria. It means brought into Nigeria in convertible currency and paid into a domiciliary account approved by the government. So now, this is now like looking like that of that dividend. You earn foreign income and you bring it into Nigeria, you are putting it into a domiciliary account which is convertible. It means that you can convert your dollars into naira. Now, interest accruing to a person who is not resident in Nigeria, interest on loan charged on public revenue of federation raised in the United Kingdoms, and all of these ones here, don't need to read them. You can read them on your own. Another one of interest here is interest on loan granted by a bank to a person engaged in agricultural trade or business. So any loan granted by a bank for the purpose of agriculture is exempt from interest. Fabrication of any local plant and machinery, when you are making a local plant and machinery. Then we also have cottage industry. So take special note of these ones. So we've talked about interest income. This is when you lend money as against dividend income. In both cases, you give out your money, but in dividend income, you are a shareholder, and so you receive profit when it is distributed. But in the case of interest, you are not a shareholder, you are a lender, and so they pay you your capital and your interest. Both of them are investment income. We've seen the incomes that were exempt from tax. Now we go to royalty income. What is royalty income? Royalty income is a payment to an owner for the use of property, especially patents, copyrighted works, franchises, or natural resources. Now this is different from rent. Let me show the difference now. Let's say I have something I'm giving out for let. Let's say my Zoom account, I am renting it. That is rental income. But now it's different from royalty income in the sense that you have your intellectual property. Let's say I designed a particular blueprint, or even let's look at Mr. Biggs. Mr. Biggs is a brand. Coca-Cola is a brand. And you want to now do Coca-Cola business in Nigeria. You will have to go and obtain a franchise saying that you are going to maintain the quality and standard of Mr. Biggs or Coca-Cola. And you are doing it here in Nigeria. You are promoting a brand name. You have to pay. So people are coming to patronize you because of that brand name. So you are not hiring them, you are not renting them, but you are providing their services, you are promoting that brand. Or look at it again. Some of these musicians that sing song, let me use one, let's say Burna Boy or Wizkid or Davido. He sings and people are marketing his products. You are streaming them on their YouTube page. You download their videos, you watch, they go on shows, concerts, and you pay the organizers. They are going to be paying these artists a royalty. Or look at natural resources. Nigeria as a whole has all the natural resources, and the company is now mining oil. When the company is mining oil, taking oil from the ground, crude oil, the company must pay for taking that natural resources from the ground and doing business with it. So they must pay the federal government royalty. A royalty payment is made to the legal owner of all of these things for the purpose of generating revenue. In most cases, royalties are designed to compensate the owner for the asset use. So, like in the case of natural resources, these companies that are drilling, they are compensating the Nigerian government for using these natural resources. Income chargeable. Royalties are normally expressed as percentage of the revenue. So when you want to see royalty, they will tell you they express it in percentage. So what is my percentage? When you hear somebody say, what's my percentage? It could be commission, but sometimes it's also royalty. So percentage of the revenue. Okay. So income exempted from tax. Now, royalty earned from abroad and brought into Nigeria shall be tax exempt. Why? If you put them into convertible currency in a domiciliary account. So you see why most people will want to go and get a domiciliary account in Nigeria, and when they have this income in their foreign domiciliary account, they will bring it to Nigeria by transferring it or wiring it into Nigeria into their domiciliary account, and it will not be taxed. That's it. So we've seen the four incomes here that are investment income. The investment income here is you don't work, but you earn. You don't work all the time. You just work once and you earn multiple times. For example, you build your house once, you rent your house once, but you are receiving monthly or yearly income. You paid for shares just once. You are not the one doing the business. But when the profit comes, every year you are being paid. You lend your money once and you are paid interest. You sing once and people are buying your songs, buying it and paying you royalty. This is investment income. You've invested in the company that you bought shares, you invested in giving out your money on loan, you invested in building the house and putting it for rent, you invested in your intellectual property or natural resources. Now, what is the tax that they are taxing you there? That tax from investment income is called withholding tax. Any tax that is being charged on, mostly the first time that they're deducting any tax they first deduct at source from investment income is withholding tax. But some of them you will still also deduct income tax from them. But we'll come to that later. Let's look at basis of assessment and payment on taxes. Now, the basis of assessment of dividends, interest, rent, and royalty is what? Preceding year basis. What it means here is that all the rent you received for 2023 shall be accounted for tax in 2024. This is unlike the employment income where you receive it in 2023, you are accounting for it in 2023. That one is actual year basis. But you see, employment income is actual year basis, dividend income or investment income is preceding year basis. All right. Now, there is something called franked investment income. Sometimes you will see us writing something called FII. We'll call it, you see us writing FII. What is FII? when you see FII, it is franked investment income. What is this franked investment income? Now, dividends, dividend income. Why? Dividend received by a company deduction of it is the company that will receive it, not an individual. Another company. Now that company that is, let's give an example now. Let's say FCA is giving out dividends. Go Getter is a shareholder to FCA, and so FCA is paying dividends to Go Getter. Go Getter received dividends from FCA. FCA will deduct withholding tax before paying to Go Getter. The withholding tax is 10%. Let's say we're talking about 1 million naira here, and Go Getter suffers withholding tax of 10%, which is 100,000. And FCA pays Go Getter 900,000. Now that's 1 million, which is gross already, because I told you that whether you receive it in net, you must put it as gross. That 1 million naira that you are supposed to receive, or which you received, is regarded as franked investment income. Now, in this case, now to the receiving company, to Go Getter. So when you receive dividend income, not when you pay, when you receive dividend income, it is franked investment income. Why? Because for you to get this income, FCA would have suffered tax before they share the income to every shareholders, including Go Getter. Now, Go Getter received it. It has already suffered another tax, which is called withholding tax. So it is regarded as franked investment income and should not be subjected to another tax in the hand of Go Getter, because that income has suffered two taxes. One, even that 1 million that you are supposed to pay, it's not the 1 million that is the real money. You must have suffered tax before you know this is profit after tax. This profit after tax is what you are now sharing. It has suffered tax. Profit after tax is now being shared, and you have suffered withholding tax from it again. So no need to suffer more tax on it. So it is called franked investment income. And the withholding tax deducted is the final tax. Is the final tax. Because income tax has been suffered at the first instance. And when it is coming to you, withholding tax is being affected. And so this is the final tax deducted on that income. Now, dividend income will be excluded from the total profit of a company receiving the dividends before the computation of the company's income tax liability. So what they normally do is that when they are bringing all the income received from all sources, they will include that. Then they will deduct it, because if you don't deduct it, you are going to charge tax on it. So you first of all include it to recognize that this income was earned. You will remove it to show that it is franked investment income. Then before you now charge tax. Now, where a dividend is received, which we will now call franked investment income. Now, I am using the case of Go Getter. Now, where Go Getter received dividend, let's say from FCA, now it is called franked investment income in the hands of Go Getter. And now Go Getter is distributing this dividend to its own shareholders. Let's say there are two shareholders in Go Getter. Let's say Chimaroke is one of them, Marianne is another shareholder. So it means that one, FCA is paying shares dividends to Go Getter. FCA will remove withholding tax. Let's use figures. FCA is giving out 1 million naira as dividends to Go Getter. Now, FCA will deduct 10% and will give Go Getter 900,000. Now, let's say Go Getter is sharing this dividend, everything back to its shareholders, let's say 50-50. Go Getter will recover that dividend it suffered from FCA from the hand of Chima and Marianne. So it means that it's going to give them, even if it is 900,000 that is sharing, is taking it as if he's giving them at 100,000. He's going to deduct withholding tax from these shareholders in order to compensate for what it has lost. And this helps here to prevent double taxation. So we call that one withholding tax on redistributed dividend. Now, there's a difference between distributed and redistributed. Distributed dividend is when you are giving your dividends, when you are paying out dividends to your shareholders. That is distributed. That is the one FCA is paying to its shareholders. Is called distribution. So it means that Go Getter was part of the shareholders of FCA. And if FCA is paying shares to Go Getter, FCA is paying dividend to Go Getter. It means FCA is distributing dividends, and Go Getter has received its own distributed part. Now, redistributed is after you have received dividends that was distributed to you, you now distribute it again to another person. That is called redistribution. It is this redistribution that you are going to collect the tax suffered when it was distributed to you. So that's it. So far, so good. We have learned about investment income. And now let's look at some questions here. They said rental income is generally deemed to accrue to the recipient over periods covered by a payment on what? A daily basis. We learned that daily basis. Here we said in computing gain or profit from rental income for tax purposes, all the following are disallowable except, so this except is allowable. Okay, water rate is allowable, so it is not disallowed. Every other thing is disallowed. Any expense not incurred for the purpose of any rental income is disallowed. Expense of a capital nature is disallowed. Depreciation of the building is disallowed. Appropriation of profit is disallowed. Look at this one, number one. Which of the following is not, okay, you're asking the question, please explain number three. I'll come back to number three. Which of the following is not an investment income on which withholding tax is deductible? Which one is not? Of course, dividend is, interest is, royalty is, rent is, and the answer is consultancy and professional service. Let's go back to number three. They said rental income is generally deemed to accrue to the recipient over periods covered by a payment. Let me show you where it was stated here. So it means you need to read your text. You need to read your text here. We said here that, where is it again? The gain or profit arising from other person for the use or occupation of any property is chargeable to tax. They say thus rental income is generally deemed to accrue to the recipient daily. So it is this that they are asking you. It is the law. So there's nothing like explain it. The law says accrue it daily. All right, so let's see number 4. If rent is received in advance, covering a period of more than 5 years, it will be spread for how many years? For 5 years. So if rent is received for less than 5 years, let's say 4 years, it will cover for 4 years. If it is received for 1 year, it will cover for 1 year. If it is received for 5 years, it will be covered for 5 years. But if it is received for more than 5 years, it will cover for 5 years. Let's look at short answer question. Income that accrues as a result of investment decision is called what? Investment income. Royalty earned from abroad and brought into Nigeria shall be exempt from tax, provided such income is brought into convertible currency and paid into domiciliary accounts in a bank approved by the federal government. Number 3, the basis of assessment of dividend, interest, rent, and royalty is preceding year basis. All right. Let's look at number 5. Dividend received by a company after deduction of withholding tax at source by a paying company is regarded as franked investment income of the company receiving the dividend. All right. Now, the main thing now is these questions. Examination type question. Mr. Chukwuemeka Okoye completed the construction of his building, a 2-wing duplex located at Gwagwalada, Abuja. So who is Mr. Chukwuemeka? He is the landlord. He is also the taxpayer. Now, he completed that 2-wing on what date? December 31st, 2011. He rented out both flats. So rented out both flats, meaning that it is for let. And when he did rent it out, with effect from January 1, 2012. So it means that whatever he received for January to December of 2012 will be charged to tax in 2013. Whatever he received for January to December 2013 will be charged to tax in 2014 because it is preceding year basis. He said he rented it out through an estate agent. So it means you have to pay for this agent fee or so and receive rent for 2 years. So he told them, please collect 2 years rent. Now, as he's collecting 2 years rent, he's not going to see the 2 years rent as income in 1 year. He's going to spread them out for how many years? For 2 years. We said if it is for 5 years, it's going to be spread for 5 years. If it is for more than 5 years, it's going to be spread for 5 years. So now he's received rent for 2 years. Now look at the rent. We're happy here that the rent is received gross. It's received gross. If it was not received gross and it was received net, let me tell you something. If it was received net, How do you convert to gross? You will say gross equal to 100 over 90 times net. That is if we are receiving net. But if you are receiving gross, then you don't need to do any workings. Now it is received gross. That means they paid 7 million, 3.5, 3.5. Now look at the expenses: repairs and maintenance, water rates, caretaker's commission, professional charges, insurance, caretaker's wage, tenement rate. Okay, so let's look at how to solve this. So we will say here ATS3 study pack, page 265. Let me see. ATS ATS3 study pack, page 275. Is it 275 or 265? 265 or 2 this is 260. I can call it 236. I can call it 265. Anyone? Let me call it 236 to follow this page here. 236. So 236 236. Now, this is an exam type question. Say 14.93. 14.93. 14.9.3. We now say Mr. Chukwuemeka is here. Chukwuemeka Okoye. Chukwuemeka Okoye. So what happened here is the computation is to compute his rental income accessible to tax for the relevant years. So you say rental income for 2013 and 2014 years of assessment. Why is it 2013 and 2014? He received rent for 2 years, 2012 and 2013. The one of 2012 is 2013 payable. The one of 2013 is 2014. So what happened? This is the rent he received gross. So let's write the 2 years. This is years of assessment. So I have 2013 and I have 2014 here. So this is my Naira sign. This is my Naira sign. I'll take this up now. And I will say rent gross. It must always be gross. 3,500,000. 3,500,000. If it is net, I told you how to convert it to gross. Now, expenses. Before we take the expenses, you go to the additional information. Capital allowances agreed with the relevant tax authority for 2013 and 2014 were 480 and 120. So let's take it here. Less addition, we are going to less allowable expenses. Less allowable expenses. Now, part of them is capital allowance. Capital allowance is charged in place of depreciation. So we say it is 480 and 120. 480, 120. 480, 120. Okay. What's the next one? Repairs and maintenance comprise the following. Look at repairs and maintenance. Now this is 220 and this is 450. Now look at the build-up of what gives you this 450 here. Of course, this 220 is 100 and 120 gives you 220. Let's see this one here. 85 plus 180 plus 185. That's what gives you the 450. They're telling you what is composed of. Now look at this repairs and maintenance. There's depreciation here. Depreciation is not allowed. Repairs of tenant's bathroom. Who is the tenant? The people paying the rent. This is allowed. Then repairs of Mr. Chukwuemeka's residence. This is not allowed because Mr. Chukwuemeka is not paying rent. He's not paying rent. He is a taxpayer who is the landlord. He's not paying rent. So this is only one we are going to take. Repairs of tenant's bathroom. So you come here. Repairs of tenant's bathroom. How much is that? 0 and 180. So we have 0 here. Then we have 180. So it means here we have dealt with repairs. Dealt with repairs. Then the next one, tenement rate includes. Look at tenement rate. That means as we are dealing with this, we are dealing with this already. Now, what they say here is 5,000 and 20,000 paid on the private residence of Mr. Chukwuemeka. So what it means here is that this 5,000 is paid for Mr. Chukwuemeka for 2023. He paid 25,000 as total tenement rate. But 5,000 out of it is for his personal use. So this 5,000 naira is not allowed. The same thing to this 20,000 out of 32,000 is not allowed. So which one is allowed? Let's do the one that is allowed. You will not say tenement rate. You open a bracket here. You say how much was paid 25. This one is 32. How much was paid here? We have 25,000. Let me open another one here. We have 32,000. Now, among these ones that was paid, this is what the one that is not allowed. 5,000 is not allowed because it relates to the private residence. Just like this 120 and 185, we are not allowed. So this 5,000, this 20,000 are not allowed. So you remove it. You remove 5,000 here. You remove 20,000 here. So it means this is 25 minus 5, which will give you 20. So 20,000 is allowable. 32 minus 20 will give you 12. 12 is allowable. So instead of 25 that was here, what should have been here is 20. And instead of this 32 here, what should have been here is 12. So we've done with tenement rates. So we'll go up now and check the ones we have not done. We've done repairs, we've done tenement rates. We'll now take water rate. We'll put the water rate now, 82 and 105. Water rate, 82, 105. What's the next one? We have agent's commission, 350 in all. Agent's commission, 350. 350. What's the next one again? We have professional charges, 100 and 150. Professional charges, 100, 150. What's the next one? Insurance. We said before insurance is allowed, 52, 52. So we have here insurance, 52. We have 52. What next? Caretaker's wages, 18 and 22. Put the 18 and 22 here. 22. Of course, this is caretaker wages. Are we done? Yes, we are done. So we've gone through. So before we go through like this, it is best to do additional information. And anything we are taking in additional information, we are marking it out here. That's why it's good to do additional information first, so that you tick off from the main account. And after that, you go back and do the ones that you have not ticked. So that's it. We will now look for the answer here. This is going to be your net rental income chargeable to tax. So this is the income that is chargeable to tax. So let's see it here. Let's calculate. We have 3,500,000 minus 480 minus 20,000 minus 82,000 minus 350,000 minus 100,000 minus 52,000 minus 18,000. That gives you 2,398,000. 2,398,000. Then we'll do the same thing here. Let's use a different calculator. We have 350,000, 3,500,000 minus 120,000 minus 180,000 minus 12,000 minus 105,000 minus 350,000 minus 150,000 minus 52,000 minus 22,000. That gives me 2,509,000. 2,509,000. Now, this is what you are asked to find. So that's typically how rental income will look like. In our next class, we will be solving some more questions on investment income, dividend income, and perhaps royalty. That will mean that we'll be taking another topic called withholding tax. So withholding tax, we'll see how we can solve for dividend income, interest income, and the like, because normally we are not just, as we did in this rental income, we're not just looking for income chargeable to tax. We are going to be looking at withholding taxes that have been charged on them. So that's our topic for next class, withholding tax. So that the knowledge will be complete. When you learn investment income, the next natural topic should be withholding tax, because they go hand in hand. So if you have any question about this class, please ask me on WhatsApp. The recording of this video is made available to you when it is available. So thank you so much for the time spent in class. I'll see you again in the next class.